Okay, I want to ask you something really honestly. Can a 10,000 rupee monthly salary actually turn into 40 crore rupees? Like, is that even mathematically possible? Most people I know would laugh at this question. They would say, Shivani, be serious. 10,000 rupees barely covers rent and groceries in Bangalore. How is anyone building crores from that? And you know what? I used to think the same way until I actually sat down and did the math myself. And the numbers genuinely shocked me. Because here is what I have learned. Your starting salary does not decide your final wealth. The choices you make with that salary do. That is the honest truth. So, in this video, I want to walk you through four completely different paths that a person earning 10,000 rupees per month can take. And by the end, one of these will feel exactly right for you. The first option is what every Indian auntie and uncle will tell you to do: safe, boring, guaranteed. The second option is where you start playing smarter. The third option is what I call the aggressive path. And this one is genuinely exciting. But the fourth option, okay, I am going to be really honest here. This is the one nobody talks about. And it is the one that actually makes people go from a 10,000 rupee salary to 40 crores. I cannot wait to share it with you. Every number in this video is based on real July 2026 data, current FD rates, historical Nifty returns, verified mutual fund performance, no hype, just math. So grab a cup of chai, get comfortable. This is going to be a good one. Let us start with the first option. So, the first option is what I lovingly call the mummy papa approved investment, the fixed deposit. Come on, we all know this one. Your father has that thick file of FD receipts in his cupboard. Your mother genuinely believes that a beta who puts money in an FD is a responsible beta. And honestly, they are not entirely wrong. FDs are safe. FDs will never lose your money. So imagine this. You earn 10,000 rupees every month. You are smart. You save 30%, which is 3,000 rupees, and you put this into an FD every single month. Right now in July 2026, banks are giving around 6.5% on fixed deposits. That is a fair average. Now, let us be realistic. Your salary will not stay at 10,000 forever. Every year, you will get some increment. So let us assume your salary grows by 10% each year, and we also have to factor in inflation, 5% per year, which slowly eats your money. All right, so what happens? After 10 years of putting 3,000 rupees into FD every month, your corpus becomes 7,60,000 rupees. Sounds decent, but because of inflation, the real purchasing power is only 4,70,000. Yeah, that hurts. Fast forward 20 years, you have 34 lakh rupees. Feels like a lot, but its real value is just 12 lakh 80,000 in today's money. 30 years in, you're sitting on 1 crore 15 lakh rupees. Sounds impressive. But adjusted for inflation, its actual purchasing power is only 26 lakh rupees. And here is the shocker. After 40 full years of disciplined FD investing, your corpus becomes 3 crore 48 lakh rupees. But its real purchasing power will be just 49 lakh 50,000. Basically, 50 lakhs in today's money. After 40 years of sacrifice. Are you feeling what I am feeling right now? Yeah, that is disappointment. Because FDs are safe. But safe is not the same as smart. Your 20s and 30s are honestly not the time to play it this safe. You have decades ahead. You can afford to take some calculated risk because time is on your side. Okay, so if FD is too safe, what is next? Let us talk about option 2. This is where things start getting interesting. So here is what we are doing. Still saving that same 3,000 rupees per month. But instead of putting it in an FD, we are moving into the Indian stock market. Now, before you get scared, let me clarify. We are not doing stock picking. We are not doing trading. We are not staring at charts all day. Because honestly, most people who try that lose money in the long run. Instead, we are going through mutual funds, specifically low cost index funds, because there are professional fund managers who spend their entire career doing this, and we can benefit from their expertise for almost nothing. There are three main types of index funds you need to know. Number one, Nifty 50 Index Fund. This invests in India's top 50 companies: Reliance, TCS, Infosys, HDFC Bank, ICICI Bank. Big, stable, boring giants. Over the last 10 years, Nifty 50 has given around 12% annual returns. Number 2, Nifty Midcap 150 Index Fund, mid-sized Indian companies with room to grow. Over the last decade, this has delivered 14 to 15% per year, higher returns, but a little more volatility. Number 3, Nifty Small Cap 250 Index Fund, India's smaller companies with huge growth potential, but also higher risk. Over 10 years, small caps have delivered 12 to 16%, but they swing a lot. Okay, so for option 2, we build a medium risk portfolio. Here is the split. 70% into Nifty 50 for safety, that is 2,100 rupees per month. 20% into mid cap for growth, that is 600 rupees, and 10% into small cap for that extra kick. 300 rupees, blend it together and you get around 13% annual return. Only 6.5% more than FD earn. Not a huge difference, right? Wait till you see the outcome. After 10 years, your corpus becomes 10 lakh rupees. Real value 6 lakh. Already 25% better than FD. After 20 years, you cross 61 lakh. Real value 23 lakh, almost double what FD gave you. After 30 years, you hit 2 crore 77 lakh. Real value 64 lakh. Compare this to FD, which only gave you 26 lakh. Massive difference. And after 40 years, you are sitting on 11 crore 19 lakh rupees. Real purchasing power 1 crore 59 lakh. That is a comfortable retirement, a house, a car, peace of mind for the rest of your life. See what happened? Same 3,000 rupees, same effort, but because you took a little more risk, your final wealth is more than 3 times bigger. That is the honest power of the stock market. But wait, because there is something even better. Now let us talk about option 3. This is where it gets really exciting. So here is what we know. Historical data clearly shows that mid caps and small caps give higher returns than Nifty 50 over long periods, but they come with more volatility. In any given year, they might crash 30 or 40% or jump 60%. You need mental strength to sit through that without panic selling. So, option 3 is aggressive. We flip everything. Instead of 70% in Nifty 50, we keep only 10% there. That is 300 rupees, keep 20% in mid cap, 600 rupees and go big on small cap, 70%, which is 2,100 rupees monthly. The blended return is around 15.4% per year, only 2% more than option 2. Sounds small, right? But here is where compound interest does its magic. Small differences over long periods become massive. After 10 years, you are at 11 lakh. Real value 7 lakh, just slightly better than option 2. After 20 years, you cross 78 lakh. Real value 29 lakh. The gap starts widening. After 30 years, you hit 4 crore rupees. Real value 93 lakh. Compare this to option 2, which gave 2 crore 77 lakh. That extra 2% return has literally added over 1 crore rupees. And after 40 years, hold on to your seat. You're sitting on 18 crore 85 lakh rupees. Real purchasing power 2 crore 68 lakh. That is more than 5 times what FDs would give you. I want you to really sit with this. From a 10,000 rupee salary, 18 crores, that is generational wealth. That is your grandchildren's education paid for. That is helping your parents retire in luxury. Okay, I have to be honest with you about something. Option 3 is not something I would recommend for your entire investing life. If you are in your early 20s right now, this aggressive allocation makes complete sense. You have 40 years ahead. You can weather any storm. But as you enter your late 30s and 40s, you should slowly shift back to option 2 because you will have less time to recover from a crash. That is just basic risk management. But wait, because everything I have told you so far is still not the maximum you can achieve. There is a fourth option, and I want to warn you, this one is going to blow your mind. All right, so option 4. This is the one I honestly think is the best strategy for anyone starting their career. And it is the option that no other finance channel wants to talk about because it does not sell mutual funds or FDs. The fourth option is to invest in yourself. I know. It sounds so cliche, right? Every LinkedIn influencer says this. It has become a meme. But please hear me out because when you actually run the math, it is genuinely shocking. Let me share a truth with you. There is no investment asset in this world that can give you 30, 40, or 50% returns every single year for decades. Not stocks, not real estate, not gold, not even crypto. But there is one asset that can, and that asset is you. Think about this. When you are a fresher earning 10,000 rupees per month and you invest 15,000 rupees in a coding bootcamp or a data science certification, 2 years later, your salary jumps to 40,000 rupees per month. That is 300% income growth in just 2 years. No mutual fund can match that. Or think about the Indian professional who invests 15 lakh rupees on an MBA from ISB or IIM Bangalore. 2 years later, the salary jumps from 8 lakhs to 25 lakhs per year. That is 100% return on their MBA every single year. Or a college student who spends 6 months learning digital marketing, product management, or AI tools. Their starting salary jumps from 3 lakhs to 12 lakhs. That is 300% return on their time investment. This is the truth nobody wants to say out loud. Mutual fund returns of 12 to 15% per year are impressive. But your own income growth potential in your early career is 30, 50, sometimes even 100% per year if you invest in yourself correctly. And here is where the math gets really wild. If you grow your income by just 25% per year for 15 years, you go from 10,000 rupees monthly to 28 lakh rupees per month in 15 years. If you grow at 40% per year, which is achievable in your first 10 years of career, you go from 10,000 monthly to 2 crore 80 lakh rupees per month. And if you maintain 49% income growth per year, like some of India's most successful professionals have done, you reach 21 crore rupees per month by year 25. Let me put all four options next to each other after 25 to 30 years. FD gives you 1 crore 15 lakh. Medium risk stock market gives you 2 crore 77 lakh. Aggressive stock market gives you 4 crore. But investing in yourself, done seriously, can give you 40 to 200 crore rupees plus in wealth. The difference is not 2 times or 3 times, it is 30 times or 40 times. Because when you invest in yourself, two engines run at once. Your income is growing and your investments are compounding. Both engines fire simultaneously. So, how do you actually do this? Let me break it down. First, spend money on online courses. Coursera, Udemy, Great Learning, Scalar, Coding Ninjas. If a 5,000 rupee course helps you land a job that pays 5 lakh more per year, that is a 100 times return. Second, spend money on high quality books. A 500 rupee book by Ratan Tata, an Ambani biography, or Warren Buffett insights can change how you think about business forever. Third, spend money on certifications. CFA, PMP, AWS Cloud, Google Analytics, digital marketing certificates. Each one can add 2 to 5 lakh rupees to your annual salary. Fourth, spend money on networking. Attend industry events, conferences, meetups. The people you meet in your 20s and 30s become your career accelerators later. Fifth, spend money on tools that make you productive. Better laptop, software subscriptions, faster internet. If it helps you do better work, it is an investment. And sixth, this one is the most important, start a side hustle. Even a small freelancing gig teaches you sales, marketing, negotiation, client management. Skills you can never learn from a salaried job alone. Now hold on. I want to be clear about something. Investing in yourself does not mean you skip mutual fund, SIPs. That would be a huge mistake. Both work together beautifully. So here is the ideal combined strategy for someone earning 10,000 rupees per month. Save 30%, which is 3,000 rupees. From this, put 60% or 1,800 rupees into option 3 aggressive mutual fund portfolio and put the remaining 40%, which is 1,200 rupees, into monthly self-investment and watch what happens. Over 5 years, that self-investment compounds into serious salary increases. Your income might grow from 10,000 to 50,000 per month. By year 10, your income might be 2 lakh per month. Your SIP jumps to 60,000 per month. By year 20, your income could realistically hit 10 lakh per month. Your mutual fund corpus is now 15 crore plus. By year 30, your monthly income could be 50 lakh. Your total corpus could easily cross 40 crore rupees. This is how a real person starting with just 10,000 rupees per month actually reaches 40 crore rupees in their lifetime. Not through lottery, not through get rich quick schemes, but through two simple strategies working together. The reason most Indians never reach this level, it is not because they earn too little. It is because they only invest in mutual funds. They forget to invest in themselves, or they invest in themselves and never save any money. Balance is everything. So, quickly, what should you actually do starting today? If you are in your early 20s earning 10,000 to 30,000 per month, go with option 3 aggressive and invest hard in yourself. Courses, certifications, side projects. If you are in your late 20s or early 30s earning 30,000 to 1 lakh per month, shift to option 2. Balance 70-20-10 portfolio. Keep investing in yourself but focus on high value skills. If you are in your late 30s or 40s, slowly reduce equity, add debt funds and FDs. But do not stop investing in yourself. Your skills are what fund all your investments. And if you are in your 50s or 60s, focus on capital preservation. Enjoy the wealth you built, but the worst thing you can do? Nothing. Because inflation is silently eating your money. 10,000 rupees today will be worth just 3,500 rupees in 20 years. Doing nothing is not being safe. It is actively losing money. Okay, here's my honest closing thought. Do not let your current salary define your future wealth. Please. Do not compare yourself to others who started with a better first job. Do not think you are behind just because you started small. The magic of compound interest and self investment works exactly the same for everyone. A 10,000 rupee salary in 2026 has the same wealth building potential as a 30,000 rupee salary from a decade ago. What matters is that you start today, you invest consistently, and most importantly, that you never stop investing in the one asset that will genuinely transform your life, which is yourself. If this video shifted how you think about your salary, please share it with a friend who is just starting their career. Show them that even a small salary can build a real fortune with the right strategy. And if you want more honest content about money and investing for Indian reality in 2026, please subscribe to Shivani Talks Money. I will see you in the next one.